the LPMCL's CME relationship, where they've got a footprint in both markets, haven't they? The liquidity spigot is broken. It's completely broken. They don't have liquidity anymore to be able to pull this back. You can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80.
The tension in the silver market is no longer subtle. It's showing up in the structure of the futures curve, in the cracks between global trading hubs, and in the behavior of traders who usually keep things orderly. Andrew Maguire argues that backwardation heading straight into a major delivery month isn't a coincidence. When the near-term price trades above the later months, it usually signals tight physical supply. A little of that is normal. What's happening now isn't. The size and timing don't line up unless the underlying inventory is strained. London, the CME, and Shanghai have always been linked through sophisticated players who arbitrage price differences and move metal around when things get out of sync. But Maguire says those players have stepped back. The big pools of physical silver that once absorbed shocks have thinned out. So when prices ripple out of alignment, nobody has the metal or the balance sheet to bring things back into line. Gaps stay open. Then there's the SLV situation. Billions in short positions are sitting on that ETF. Some of it is normal hedging from authorized participants, but some of it isn't. If too many holders decided to convert their shares into actual metal, the system wouldn't have enough silver to satisfy them. Paper claims have multiplied far faster than the available supply. That's why Maguire calls the shorts trapped. They're covering against each other because no fresh liquidity is arriving to ease the pressure. And unlike dollars or credit, you can't conjure physical silver out of thin air. In a squeeze, the people short metal face a problem with no easy escape. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The real actors are gone. And I think this open interest that's in there, it's very limited as to what they can actually rinse out, because we've got physical markets being set in China. We work with the liquidity providers who interact with the Shanghai International Exchange, and really looking at what they're talking about. There's very little. It's interesting because I think what really sums it up, and you and I were talking about backwardations a little while ago. While we have unprecedented backwardations, we've seen $3 backwardations in the past. They get arbitraged one thing and another, but so close to first notice of the largest delivery contract of the year. We're seeing on last Friday 60 cents, $3,000 per contract offside. Now we're still looking at 20, 30 cents. I mean, ludicrous into first notice. Through options expiry into first notice, which is actually supposed to be tomorrow, but it actually happening today because it's
goes off the board on Wednesday and trades first notice on Friday. Yep, end of the month.
Exactly. So, so what it tells us, what it screams at us is, hey, you can't have a backwardation coming into a delivery month where it's not telegraphing to you it's mispriced, severely mispriced. And I think the reason for that, Craig, is because the LPMCL's CME relationship, where they've got a footprint in both markets, haven't they? The liquidity spigot is broken. It's completely broken. They don't have liquidity anymore to be able to pull this back. And what you got, like 4 billion in SLV shorts, and some of that, yeah, there's going to be some legitimate hedging in there, but 4 billion in short positions. That means that if I own an SLV share, it isn't there necessarily, not if everyone wants it at the same time. And so I think it's screaming. I mean, to be honest, I think these guys are turning in on themselves. And like I said today in an episode, I think they're fighting like rats in a sack now, trying to short cover these massive shortfalls because nobody is there to help you anymore. And literally, you can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80. That's where it extrapolates. Yeah, and I think silver is the Achilles heel of this same group of people. RPMCL are just the four banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens. All the institutional guys, as we've just said, they've exited. And now you can still access as an institutional trader. I can then go in and tag the SGEI gold corridor, which is opening up big time. Can access an increasing number of vaults, gold and silver that can be traded with a real physical price that is much more stable than this unbelievable paper toxic mix that is thrown in. And it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price.
Right.
It's not a COMEX derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market.
The shift Andrew Maguire is talking about isn't a small adjustment in taste. It's a structural change in who is showing up in the gold market. Money managers who spent decades trusting treasuries as their anchor suddenly see cracks forming. When the bond market sends distress signals, they don't wait around. They look for something that can sit outside the system, and gold ends up at the top of that list. But there's a catch. Most of these big funds can't actually buy physical metal. Their mandates funnel them into paper versions like ETFs. So when a fund decides it wants a 20% gold allocation, it isn't stacking bars in a vault. It's loading up on ETF shares. A decade ago, even mentioning 0.5% would have gotten you laughed out of the room. Now those same rooms are full of funds scrambling to build positions they should have started years ago. What this really means is the demand hitting gold ETFs isn't hot money looking for quick gains. It's long-term capital shifting from zero to meaningful exposure. That's sticky demand. Lower prices don't scare these buyers. They see dips as a chance to fill in the allocation they're still building toward. Let's get back to the interview.
Yeah, I think silver was just a little, was just the more obvious version of that. But yes, because it's hard to hide the footprints. But absolutely, this is, as we know, central bank, sovereign, institutional buying. Now, all of a sudden, we've got, for all the reasons you have, the cockroaches running around in your treasury markets now. And I think people are looking at it and going, hey, yeah, I really have never had exposure to gold. So institutional traders, buyers are saying, I need some exposure. So the problem is, and this is what's confusing a lot of people, problem is a lot of these guys are not mandated to hold physical, especially the US guys, not mandated to hold physical. They can buy and sell shares and they can do it on the click of a mouse. They are now, as we know, we're talking about the 40, 2020. So we're looking at a lot of people coming out and saying 20% allocation to gold. Hey, can you remember any of this
Oh my
trade?
goodness.
I mean, it was like you wouldn't even have 1%. You
Right.
wouldn't even have a 0.5%.
You're a lunatic to even bring it up.
Exactly. So now you've got all these institutionals. Now, the interesting thing is they can't necessarily buy physical. They're buying the ETF. Now, you and I are great. We don't believe in the last place I want to go and buy gold is an ETF. However,
Right.
they have no choice. So, but because they're buying for keeps, they're not going to take delivery. They are going to own that position, and it's sticky. They cannot be rinsed. You cannot say, and in fact, you drop a price down, they'll buy more because they're buying more every day because they're moving from zero allocation to 20 to 25% and more in some instances for obvious reasons. So therefore, people look at it and go, oh, look, there's all this open interest building in the ETFs. It's not speculative. This is sticky stuff. And obviously the physical market is all we care about, but it actually is forcing, even though there's shorting going on in the GLD and one thing and another, it's still a physical market. And it's the physical supply demand is being set outside of the LBMA ring fence.
Mhm.
And so therefore, it's back to same as silver. If I have a bar and I have to own it before I can sell it, I need a real price. I want a real price. So I will only sell it to you. And the more you want, the more I want. You got backwardations in December, although the next liquid contract is March. But when
For
you look
silver.
at silver, sorry. So, but then if you look at January, that's already in
Teetering.
technical backwardation. So
Mhm.
it is happening. It is happening already. And now we're talking about 2026, and they're not even done. I think this morning I looked, there was still, I think, 2,000 odd tons of silver warrants floating
Yeah.
around in there. And the thing is, there's a lot of people that I know and who are saying, well, yeah, we bought and we're taking delivery. We are taking delivery.
Mhm.
Why? Because it's the only source of physical that I can get to my limit, to my actual limit. I can buy that. And so if that's the only source of physical, going to be banging on that back door, out it goes. So how can that possibly be? And that's mispriced. It's so grossly mispriced. And furthermore, even if it was more expensive, people would still be lining up to get it because there's not enough on offer to meet all the demand. So it is a toxic mix. And as I say, that's why I think these guys are like rats fighting in a sack.
What's unfolding in the precious metals world feels less like routine volatility and more like a system shifting under its own weight. Stress in silver isn't coming from rumor or emotion, it's showing up in places that normally act as shock absorbers. When the curve inverts, hubs drift apart, and the usual arbitrage desks no longer smooth the edges, you're looking at a market that's running short of the one thing it can't fake: physical supply. At the same time, gold is absorbing an entirely different kind of pressure. Large pools of capital that once treated treasuries as unquestioned bedrock are quietly redirecting their anchors. The move into ETF gold isn't speculative churn anymore. It's deep pockets rebuilding their defensive lines after realizing the old safe haven doesn't behave the way it used to. Put those forces together and you get a market where physical scarcity collides with institutional repositioning. Silver is tightening because metal is scarce. Gold is firming because trust in the traditional playbook is thinning. All of this leads to a simple but uncomfortable thought. If physical stress keeps building in silver while long-term capital steadily migrates into gold, are we approaching a moment when the paper versions of these markets can no longer stretch far enough to hide the underlying shortages and the shift in institutional priorities? So stay tuned. If you're into real, data-backed takes on the financial system. Hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.